session. Okay, looks like it's recording, so we should be good to go. All right, welcome everyone to another webinar. As you know, we usually have these webinars every other week. And since we're in the busy part of earnings season and I didn't have too many other things going on, I was able to allocate some time towards having extra webinars here during the earnings season. I can't promise that we'll do it again next earnings season, but I'll try. And let's see, let's get through the preliminaries here. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors, nor are we registered investment advisors. Neither do we provide investment or financial advice, nor do we make investment recommendations. The webinars given by optionslam.com are for educational purposes only. So any trade strategies that are illustrated in these webinars are not a suggestion or a recommendation to engage or to take part in or to buy or to sell. They are for educational purposes only. Your trading, you shall be fully responsible. I'll just read from this. This information neither is nor should be construed as an offer or solicitation of an offer to buy or sell securities. You shall be fully responsible for any investment decisions that you make, and such decisions will be based solely on your evaluation of your financial circumstances, investment objectives, risk tolerance, and liquidity needs. I am Marco. This is my email address, optionslam.com@gmail.com. Look forward to hearing from you. Please feel free to reach out with your comments, questions, suggestions. Let's see. So this is a slide from last week. A friend of mine, fellow trader, emailed me. He said, "Hey, what a great idea, Marco. Design strategy based on people's calling in with suggestions about their stocks. It's kind of like the Lightning Round you've seen on, CNBC." And so that's where that lightning round idea came from. We're nothing like the lightning round. That's the Jim Cramer thing where he gives you his bullish or bearish outlook on any given stock. I know enough about trading and enough about stocks that I know that if I give you my bullish or bearish outlook, there is about a 51% chance that I'm going to be wrong and a 49% chance that I'm going to be right. That's basically my batting average. So I'm most often personally, in my own personal trading, I'm most often trying to take a delta neutral stance. And I also try to keep in mind that stocks don't move as much as their implied move. They usually move inside their implied move. So I usually design my strategy around those concepts. And that's why I've been kind of laying into the single winged iron condor, the regular iron condor. I do trade naked short strangles. And also the risk reversal is an excellent strategy. Those kind of fit my attitude. But in these webinars, we talk about all different kinds of strategies. So let's move on. Considerations when designing option strategy is expectations. So I just talked about what my expectations are, but yours might be different, right? So you might expect the stock to move very big on a certain earnings event, okay? Or you might have a directional bias, bullish, bearish, whatever the case might be. And how far do you expect the stock to move? So these are the expectations we need to take into consideration when designing option strategy. And how much time do we expect it's going to take for the stock to move to that point? So what's the distance? But just as important as distance is how much time should I allow? Oftentimes it makes sense trading, designing option strategy to give more time than you expect it might take, just so that now you can always roll out. You can trade front weekly options, and if price doesn't achieve the uh, the goals that you had expected inside of that very short time frame, you can roll your strategy out. You can modify it, adjust it, and buy more time or sell more time, whatever the case might be. Implied volatility changes are very important when taking on through the earnings type trades. When we're doing through the earnings type of trade, that type of a earnings trade where we put the trade on right before the earnings event, we need to be aware that we are going to experience implied volatility changes, and that change is going to be a volatility crush. So IV is going to get sucked out of those options, both the ones we bought and the ones we sold. And this all needs to be taken into consideration in designing strategy. So Leonard and Sam brought a few ideas to the table. I'm going to get to these. PayPal, bullish. Okay, I'm looking for my notes. As I mentioned earlier, GoToWebinar has completely changed the interface, and I do not see my notes. Okay, here they are. Here they are. Okay, here they are. You guys should just see the one screen. Is that correct? You're just seeing my one screen that shows 1, 2, 3, 4, 5, 6 bullet points. This is very awkward. I don't like this new interface. Okay. It's not better. Let me put it that way. Yeah, Sam. Okay. But you're just seeing one screen, just those notes, those 6 bullet points. Is that correct? Because I got multiple monitors. Yeah. Okay. Good. Okay. All right. I found my notes. We're gonna move on past the screen here, but we'll come back to this for the ideas. Let me just read through it here. Leonard brings some great ideas to the table. He's thinking, he's leaning bullish on PayPal. However, I don't know how bullish. We'll look at some things on that. We're going to look at PayPal. We're going to look at AMD. Leonard has had some good success with the Iron Butterfly. And so he's thinking maybe that might be a strategy to consider for AMD this time. So the AMD and the Iron Butterfly, and the one that Leonard talks about is actually the reverse Iron Butterfly. Okay, it's a reverse Iron Butterfly. I had a webinar that was titled "The Safer Straddle," something like that. You can look back in the archives to see that, and that really was the reverse iron butterfly. And his comment is that this strategy worked out well on FDX, Nike, and Taiwan Semiconductors, but the profit came within the first 15 minutes or so of the market open, and then the profit faded away. So we're going to talk about that. I'm going to show you some charts and some more details about that. And then Sam mentions Sam brings to the table, he's bullish on Apple, but he's very cautious. He says, let me read what Sam said. I'm feeling bullish for Apple, but lately, even when earnings are good and the market reacts, it does not move up so much. And if it does, it's just an aftermarket. And then when the market opens, it drops. So, welcome to, a bearish tone in the overall market. Well, we have war going on, multiple wars going on in the world. We have so many bad things happening, and the Magnificent Seven has been holding up the whole market, but it's kind of a false impression of where the market is. So more stocks are down. And I'll show you. I don't know if you guys are look at the what's it called? The equal weighted indexes. But I'll just show you an example of that coming up. And he also, so he's cautious. He says, so I'm feeling bearish on Myrna, and it's as it is not as volatile as it once was during the pandemic. And so let's move on. Well, I want to suggest that as we're designing earnings strategy, as we're designing option strategy, as it applies to an earnings event, we want to look at a few things. And I would strongly recommend that you consult Option Slam to do so. What is the EVR? Be aware of the earnings volatility rating of your stock. Where are the implied move numbers in relation to previous events? Are moves faded or extended? Okay, these are questions that can be answered at Option Slam. Backtest your strategy on your stock. See how it worked in previous earnings events. Wait until the final trading hours. Okay, then as far as putting the trades on, oftentimes in these webinars, we design the trade a day or two or three, sometimes even a week before the actual earnings event. The actual trade that you should consider putting on needs to be adjusted based on to where the stock is trading in those final hours before the earnings event is announced. Because the stock, when we're analyzing a trade today and they don't report until tomorrow, the stock could be at a totally different place tomorrow. It could be up $5 or down $5. And you would need to adjust your strikes accordingly. And once you're in the trade, this is something I haven't talked about too much, but you need to manage that trade. And Leonard brings that up in the reverse iron butterfly. If you're not there to lock in the profits when they're available, they could totally slip away. And that winning trade could turn into a loser in a very quick and short period of time. So certain trades require that we go into what I call day trade mode. And to go into day trade mode, you need to have a price chart other than the daily and weekly. You need to have a 5-minute chart, is my personal favorite short-term chart. I don't like the 1-minute chart. It's way too fast. I don't like tick charts. They're way too fast for my style of trading. Okay. So there's a few things that I'm going to try to remember as we go through and design some strategies. So let's go over to Thinkorswim and we said bullish on Apple, if I remember right. Let's see, who was that? Leonard was PayPal and AMD. Let's do those first, okay? PYPL, PayPal. All right, so Leonard bullish on PayPal. Basically, he mentions that primarily just because it's been shot down so far. So before we get into PayPal, let me tell you about what I was saying, and I'll forget if I don't do it right now. So if we look at the SPX, if we look at the S&P 500, and let's look at a 3-year weekly chart, okay? 3 years weekly. All right, so okay, there's the SPX, S&P 500. This was that bull run in 2021, started in mid 2020 after the Corona crash, and then so where does this chart start? This chart starts at November of 20. Okay. So that bull run actually started before that. It was like August, wasn't it? Or maybe even sooner than that. Anyway, there's the all-time high of the S&P 500. Okay, and there's a quick look at the chart. Now let's look at that. Includes 500 stocks, including all your favorites. The Magnificent Seven are all included. What if we look at the SPX equal weighted? It is a much different look. It has that same bull run, but it's really flattened out comparatively. So let's do one more study here, and let's do add a study, compare with. The SPX. Okay, so you can see now really they've kind of flattened out. So this starts out, here's the SPX itself, and here's the SPX equal weighted. So what this does is it rather than giving Apple a larger share of the index, it just every stock in the index gets an equal weight. Okay, I think that's self-explanatory. So I think it's something to be aware of. All right, so let's remove studies. Okay, and let's go back to, we were going to go to PayPal. So, all right, so bullish on PayPal. I'm going to go back to the 1 year daily chart. And you can see that just in this 1 year, PayPal has come down. It's pretty much been cut in half. It's pretty much been cut in half over the since a year ago, from $92 down to $50. Okay, and almost in half. And I've been watching this. I don't really understand why this stock has sold off so badly. I'm not. I've been tempted actually to buy the stock myself, just because it seems to be oversold. So I have the same sentiment that Leonard has. that just because it sold off so bad, maybe that's something we could try a bullish trade on. So let's go to optionslam.com and let's look at PayPal. Okay, and so there's PayPal. So what this takes us to is the earnings history page. And at the top of the earnings history page, we see the EVR rating, okay? So if you want to learn more about EVR, you go to the help menu and you can read about EVR though, right there. So it's the earnings volatility rating. So 3.8 is a pretty high earnings volatility rating. That means the stock has the potential to move big on earnings. Let's see, I need to scroll in. I need to, shoot, I need to log out here and try this. Hopefully this gets me logged in. No. Option Slam. There, now I'm logged in. Okay, sorry about that. All right. PYPL. All right. Okay, so at the top we have some of that information that I said we need to look at. First of all, the EVR is 3.8. EVRs range from 0 to 10. So 3.8 is most stocks EVR is between 1 and 3, 1 and 3.5. So this is really kind of on the high side of EVRs. Why is it on the high side of EVRs? Because if you come down and look at the moves, you can see that this stock can move 12% and it can do so often. There's two 12s right there. Here's a 13%. Here's another 13%. Here's a 26%. This stock can move. Okay. So that's something to be aware of is the EVR. Here's the EVR history, the history of the PayPal earnings volatility rating. And surprised we only go back to 2018 on that. Let's see something here. One thing you can do is you can list all history. PayPal's been trading longer than 2018, has it not? Yeah, sure. It's gone back to 15 is where we pick it up. 2015. I think it's been around longer than that too, a lot longer. So that's interesting. I'll have to look into that. Anyway, so just over the last, since back to 2018, you can see that PayPal has been getting more volatile. The EVR has been coming up. In these years, it was down in the 2.6, 2.6, 2.7, etc. It looks like it was as low as 2.3. And here's another 2.3, but now it's up there at 3.8. So it's been getting, what this tells you is the trend is that this has been getting more volatile as time goes on. Okay, and then as I indicated, you can use the list all history page to see the details of that. Now, another thing that I suggest that you do is look at the implied move numbers. Now, you can look at the implied move numbers, what they are right now for this earnings right here at the top of any page. But if we go specifically to the implied move weekly page, now we can see what the implied move is this earnings. And our latest capture would have been the end of the day, Friday. Okay, that's the latest capture. The implied move for the weekly options, those options that expire this Friday, are at 10.5. So these are end of day. This is the last capture. Excuse me. This is let's see. This is November 1st. Okay. 10.5 would be the current. That would be the Friday capture. Okay, that would be the Friday capture. And then they don't report until a couple days from now, right? So this is going to change. These numbers up here are going to change between now and November 1st, which is the day after tomorrow, right? Wednesday after the close is when this stock is going to report. But as you can see, 10.5, how does that compare with other implied moves? Okay. Is it at the high end? Is it at the low end? This is something to be aware of as you're designing your strategy. In other words, let's say you wanted to buy a straddle, or you wanted to do the safer straddle, the reverse iron butterfly. Do you want to do that when the straddle is priced as at its highest point? In other words, look at this earnings event. The straddle was priced at almost 14%. Is that a good time to buy a straddle when it's priced higher than it's ever been priced before? Prior to that, it was at 8, 7, 4, and there's 3 more pages here. Okay. Is that a good time? Just from the perspective of how expensive options are, is that a good time to buy a straddle or initiate a reverse iron condor or a reverse iron butterfly? It, and I can't, and we don't know, but we're paying a lot. We're paying a lot for that strategy at that point. So where are we now? We're at 10.5. And where does that fit into the previous? Okay, so you can download this to an Excel spreadsheet, and you can do that simply by highlighting all the data, including the column headings, right? Okay, just drag across, highlight that data, and import that into a Excel spreadsheet. And then you can apply formulas to those to your data and find out where is 10.5. Is that the median? Is it the mean? Is it the low end, high end? But anyway, my point is be aware of it. It's something to be aware of as we're designing strategy. Okay. Now, are moves faded or extended? So the actual price move, we need to go back to the earnings history page. And we can simply look at the open, high, low, close of the price movement within one trading day after an earnings event. And so let's look at the most recent earnings event, August 2nd. The stock was at $73.20. Okay, it opened at $66.70. Okay, that's the opening price. Okay. The high of the stock that day was 66.93. So it gapped down from 73 down to 66.70. It tried to recover, but it didn't get far, only made it up 23 cents was the best it could do. Instead, it sold off more, all the way down to $64.10. And then the recovery from that was only up 8 cents to $64.18 is where it closed that day. In percentage terms, the low of the day was down 12.5% from the pre-earnings closing price, and the close of the one-day move was down 12.3%. So what happened? What I'm trying to relay to you is that this data, this information is worth studying and reviewing before you design a new strategy to put on with real money, right? So now we get a feel for where's the implied move. And I only looked at the implied move weekly. We could also look at the implied move monthly. With today being October 30th, there's what is there? 2 weeks. Let me just take a quick look at a calendar. There should be 2 weeks. Yeah, two. Let's see. No, the third Friday of November is actually 3 weeks away. There's 3 full trading weeks to the third week of November, which is the regular monthly options. All right, so we have the implied move monthly page as well, right? And the statistics are for the monthly contracts are found on that page. Okay. All right. So, and I'm not going to go through all these, but I would suggest that you do not you can't go through them all, but you could go through the most recent 2 or 3 or 4 earnings events to see what get a feel for the stock. How does this stock behave? When it has an up move, does it behave differently than when it has a down move? And vice versa, right? Where is the implied move in relationship to all the other previous implied moves? Is it high, low, or in the middle? All right, get a feel for that information. Are moves faded or extended on the daily basis is important, the one day, but also important is do the moves have legs? And you need to go to the post earnings page to discover, does that move extend past the one day? So here's that same earnings event. You see the black bar is the black navigation bar turns to all the different pages that are specific to this stock. Okay, so I simply went to the post earnings page now. So now I not only have the closing move for the one day after the earnings event, but now I can see does this stock have legs when the move is down? And this chart, this table, clearly suggests that the last 2 times it definitely did. The one day move was down 12%. Within 3 days, it was down 14%. Within 13 days, it was down 18%. And within 2 months, it was down 19%. Okay? So you can just take a look at this chart and determine that a big down move, a big one-day down move, can get worse. Okay, can go further down. So that's what I mean by it can have legs. So to be aware of all of these things. Now you want to be bullish on PayPal or whatever other stock it is, fine. You can have that opinion. But knowing how the stock behaves after an earnings event will help guide you in how to manage your trade in case you are right or in case you are wrong. All right, so with those things in mind, I would also suggest you go to the back testing page at Option Slam, which is the OSBTT, and go to some previous earnings events and just create that back test and see how that specific strategy that you're thinking of using this week, how did that perform in previous earnings events? Okay. And it's just gathering more information to get a mindset about what the stock is capable of doing, what it usually does, what it's likely to possibly do, not necessarily in the terms of what direction it's going to go. None of those things tell you the direction of the stock. They only tell you the behavior once the direction has been determined. And that's important for managing your trade. That's important for knowing when to take profits or when to cut losses. All of that data available at the optionslam.com stock specific pages is vitally important for you to initiate as well as manage your trade. Let's go back to looking at PayPal. All right. So now I'm going to get through these stocks and we're going to look at analyzing some strategy, knowing all of that, but adopting the bullish bias. One thing we didn't see at Option Slam. Let me go back quickly and look at Option Slam. Let's look at how often does this stock have a bullish move and what happens after a bullish move. Well, this bullish move was up 3% and it got eaten up pretty quickly thereafter. It got faded away. This bullish move was a one-day move and then it faded. Let's see, a week later it was up, it was back to 10, and 2 weeks later it was back up to 13. So there was a little bit of legs there, but it was sketchy. It was bouncing around. This 11% move up was faded. Okay, basically faded. Within 3 weeks, that positive move turned down. So if we're going to design a bullish strategy, what I'm suggesting is just what Leonard suggested in his comments, is that sometimes you can be right, but not for long. You can be right, and you can get some, but you better be quick to take your profits, or at least lock in part of your profits on some of your contracts. If you're taking 10, if you're a big trader and you're doing 10 contracts, you have a lot more flexibility than those that are only trading one contract. So let's look at at a bullish strategy on PayPal. Given what I know about it, if I were bullish on PayPal, I think I would gravitate towards the risk reversal. So let me illustrate the risk reversal. And rather than do the we'll do the quick trade here. We'll do the quick trade that expires this week. Let's do that, because this thing doesn't seem to have legs in the bullish direction. It does in the bearish direction. And not to say this time couldn't be different. Okay, I'm not saying that this time couldn't be different, but history tends to repeat itself. And who was it? Who was it that said history doesn't always repeat itself, but it often rhymes? Okay, so the implied move is about $5. We're trading at about 51. With the risk reversal, what we do with a bullish risk reversal is I'm going to go about. I'm not expecting a huge move in the upward direction, so I'm going to tend to go with the rather than go the full $5 implied move. I'm going to go. I'll just be generous and go about $3 of it. So I'm going to go and buy a vertical here. I'll show you the advantages to this strategy. I'm going to go out to the 56, because that would take us to the implied move. So I'm buying the 53, selling the 56. So there's the bullish vertical spread. And that's the first part of a risk reversal. And then the other side of it is to go down about $3. So I'm going to go down to the 48 and sell a vertical. I'm just going to model these up separately so that you can see the two components. But when you put the trade in, you might consider putting it all in as one order, as one order. So I'm going to go 48, and then I'm going to go down to the 44, and now we'll take a look at that trade. All right, so we're looking at that trade, and let's let me. What I like about this trade is it has a very high probability of profit. Okay, however, much of the profit zone is not much profit at all. It's only the credit taken in by the trade. So the credit spread. So what we have here is a bullish. Some people call this a bull call spread, right? A bull call spread, and they call this a bull put spread. Okay, a bull put spread. I don't usually use those bull bear names myself. I'm not used to those. I call it what it is. This is a debit spread. This is a vertical call debit spread, which is the same as the bull call spread. This is a vertical credit spread using puts. So this is also a bullish trade. So this is two bullish trades combined together. You want to design this so that the credit spread collects more money than the debit spread costs you. That way, if the stock doesn't move very much, at least you have some profit. The difference between the credit and the debit. You're not losing money, you're covering your commissions, and you got a couple bucks in your pocket. But if the stock does what you want it to do, what you think it can do, then you have a very healthy potential for profit. Okay. And then I was just going to show you the probabilities are, there's the break even on the downside designed this way, and you can adjust these strikes. And again, you should do this in the late afternoon hours of November 1st when they're going to be announcing. Is that right? Let's see. Yeah, November 1st after the close. Yep. All right. So there's that trade. Let's go on to the AMD trade. So the AMD trade, Leonard suggested that maybe a reverse a reverse iron butterfly. So let's look at it. But we need to first go to Option Slam and take some things into consideration. What is the EVR of AMD? Well, it's 2.9. It's kind of right in that average zone. It's at the higher end of average, almost a 3 EVR. What has EVRs been doing over time? EVRs have been coming down in the most recent years. EVRs of AMD were up here at 6, a very high 6, a very high 6.1 here back in July of 2017. Since then, EVRs have generally been on the downslope. Now, I can't zoom in on this chart, but if you look closely, you can see each bubble is a different earnings event. And it looks like there has been a bump up recently in the last 3 earnings events, up in the 2.9, 3.0 range. Prior were 2.7. So be aware of that. AMD has been coming down for some years, EVR wise, but recently there's been a bump up. Okay, just like reading a price chart, but we're reading the EVR chart. Where's the implied movement numbers compared to? Let's look at the implied move weeklies. We could just as easily look at the implied move monthlies. Where's the implied move of the October 31st is tomorrow after the close is when this is scheduled to report. And the most recent implied move was 9.29. Well, that's at the high end. So I'm not sure that I want to be buying a long straddle when price is at the high end of where it's been in previous quarters. So I would caution you on because what is a reverse iron butterfly? Well, it's like I proposed in that webinar. By the way, those webinars are here under resources tab, Option Slam webinars. You can go there to see years and years worth of previous webinars, similar to this one today. And it's what I called the safer straddle. I think I called it the safer straddle, something like that. It wasn't that long ago. It was only a couple of months ago. So anyway, I'd be cautious about this. Notice something when implied moves are high. When implied moves are high, what does the stock do? It moves inside the implied move. When implied moves are lower, then it has the potential to move outside the implied move. Okay? And see here, another high implied move. Well, the max move during that day was outside, just barely. But by the end of the day, the closing move, the price came back and it closed inside the implied move. All right. So is that always the rule of thumb? No, but think about it. It makes sense. If I'm paying a lot, if the market is pricing in a huge move, now the stock needs to really move huge to get past that implied move before I can have a profit. Look at this one, a low implied move, and that one had the opportunity to actually move and close outside of the implied move. Okay, so are moves faded or extended? This is another one. I need to run back to the earnings history page to see the 1 day implied move, the 1 day move. Was it what happened? Okay. Well, here the stock was at 117.60 prior to the earnings event. Okay. It's the end of the day, August 1st, just a few months ago, and the stock closed at 117.60. What happens? Opens at 119, gaps up $2, and goes up one more penny. One more penny from 119.49 to 119.50. And that was the high of day. And that's all she wrote, because all that stock did, as you can see by the table here, was sell, sell, sell the rest of the day. It sold all the way down to 107.38 and closed just slightly above that at 109.35. All right. We can jump back. We can jump back to the implied move weekly page to see how that, just to refresh our memory again, how did that pan out? And because we didn't look at this, the implied move was 8%. It did move slightly below, down as low as 8.69%, slightly outside the 8.05. But by the end of the day, it bounced back up and closed inside the implied move. All right, so be aware. AMD, that's the stock we're on, right? AMD, yes. AMD. And I'm not fun. Oh, and one more thing. One more thing. I don't know if this is, let's see, AMD. Here it is. I actually ran a back test in the Option Slam back testing tool of that trade placed on August 1st, 2023. And that trade actually did. Now this is the, all right. So I'm going to call this the reverse iron butterfly, but it's actually, as you can see, it's actually more of a condor because my longs, okay, my two long contracts are 117 and 118. All right. Because why? Because price was right halfway in between the two. It was at 117.60. Okay, you see it right here. So I just it's a reverse iron condor technically, but so is every reverse iron butterfly. They're all reverse iron condors. It's just that they share the same strike. They buy the straddle instead of buying the strangle. Okay, does that make sense? And then I went out. I believe this was to the implied move, or almost, or was it half of the implied move? I can't remember. I think this was half of the implied move. I'm pretty sure this was half of the implied move on that day. I'd have to go back and look. Anyway, risking $462 is the worst case scenario. Okay. And it profited, looks like about 11%. There was an opportunity at the end of the day, and so there would have been even better profit at the low of the day. There would have been even more profit at the low of the day. Remember, this thing went down. Let's go back and look at it. AMD implied move. Let's go to earnings history, and the stock went down all the way to 107, but it came up $2. So there was more profit, and I think there was actually an opportunity for about $120 of profit that day. I don't have a lot of time to spend on this, but I believe I might still have that in my think back. Let's go see if I still have that in think back. AMD. No, I don't. I don't have that in think back anymore. I erased it. I'll show you in another webinar. Remind me to show you in another webinar how Thinkorswim can help you dial in a little bit on what the maximum available profit was, even intraday. Something I'm just learning about myself right now. Okay, so let's see. Back to designing that strategy. So there is that strategy on the last earnings event. It was profitable. It was profitable, and I think it was even more profitable prior to the close. I think around $120. But OSBTT is end of the day statistics. Okay, so it doesn't tell you what the maximum profit was during that day. It only tells you if you would have held the strategy to the end of that day, the profit would have been $48. However, if you'd held it another day, you'd have been underwater by $85. And if you held it all the way until August 4th, when those options expired, then you would have been a loser by $344 of your $462 money at risk trade. All right. So let's see. We'll just design that strategy up just for practice. All right. We'll use the front week weeklies to do so. And again, you have the opportunity to adjust your trade, roll your trade out. But let's look at designing this strategy. All right. So stocks at one. No, we need to go to analyze, add simulated trades. We need to go to the live trades now. AMD live is at 95, perfectly in the middle. So what we'll do here is we start with, I'm going to break this up into two parts so you can see what the two components are. We're going to buy the straddle. I could also do this by buying an iron condor. Okay. But let's do it this way first. Buy the straddle. Okay. And then we're going to sell a strangle. So the implied move is about $8. I'm going to go about just beyond halfway to get my short strikes. Okay, so $8. I'm going to go out about $4. So 95. I'm going to sell the 99, and I'm going to sell the 91. So I'm buying the straddle for $7.65. I'm selling the strangle for $4.24. So the net cost is the difference between those two. Let's do it by let's do the same thing by buying an iron condor. So we'll go here and we're going to go buy iron condor. All right. Now all we got to do is manipulate our strikes. What are we buying? We're going to buy the 95 call. I'm going to do the same thing we did up here, but I'm going to do it all as an iron condor. And I'm going to change this to the 95. Okay, so now we got the 290 for the 95 call and the 95 put. Now we're going to manipulate these two, the 99 and 91. Selling the 99 call and selling the 91 put. All right, so you can see 760 minus 420 equals 340, doesn't it? 760 minus 420 equals 342, doesn't it? 340, right? So the net debit is $3.40, regardless of how I put this trade on. So let's look at the reverse iron butterfly in risk profile. So why do I call it the safer straddle? Because if I do it as a long straddle, it costs $760 to do it one time. And price needs to, let's go to the, okay. And we're going to have implied volatility crush. So that's going to be a bad thing, right? Against this all long premium trade. Part of what we talked about last week was being aware of what the Greeks are. What is my delta, gamma, theta, vega? Well, in this trade, my theta is $98. I'm going to lose $98 the first day I have this trade on. If I do it if I add the short strangle, I cut that theta from $98 all the way down to $10. Okay? I cut that theta by what, 85%. All right? And let's look at the straddle. The straddle is long vega by 8 points. Well, I know implied volatility is going to crush. So for every point of IV crush, I'm going to lose $8. And this, believe me, IV is going to crush big time. And oh, that reminds me, one thing I said last week, I want to make a correction. But before I go off on that tangent, let me make myself a note here. Not a correction, but a clarification of something I said last week. IV crushes. Okay, I'll do it right now. Crushes to zero. Well, it does crush to zero. I wasn't lying. That's not wrong. IV does crush to zero. But what I omitted saying, what I'd like to clarify, is that the 1 day IV crush, because like Leonard talked about, sometimes with trades like this, you want to take your profits while you have them, because they might disappear if you hang on too long. That's like I said, you need to go into day trading mode. You need to get to a 5-minute chart. You need to be aware of higher highs, higher lows, lower highs, lower lows. Those technical analysis types of techniques to be aware of what's going on with your stock and the price action in that day, to manage your trades. But let me just finish what I was going to say here, and then I'm going to show you that correction or that clarification on IV crush. All right, so obviously we're going overtime today. Vega, if I just buy the straddle, I'm exposed to a huge IV crush problem here. I'm exposed to a huge theta problem here. And I need the stock to move way past the implied move before I get profit. Way past held to expiration day, way past or substantially past one standard deviation just to break even. Okay. But we already know that theta got reduced to about 11. What happens to Vega when I change this to a strangle? My Vega gets cut like 90% of my long Vega is gone. So now implied volatility crush doesn't hurt me so bad. Theta doesn't hurt me so bad anymore. And you say, well, Marco, yeah, but you gave up all that potential profit, like that unlimited profit that you have in the long straddle. Well, the problem with that is stocks don't usually move to the moon, or they don't die to the toilet. They don't usually go. I mean, again, every stock is different, but we looked at AMD. AMD's got an EVR of 2.7, if I remember right. This might be a better strategy for PayPal than it would be for AMD. Although PayPal had a very high implied move. So again, I think for both of these stocks, I would be very cautious of this strategy. But anyway, the point is that the stock, what I'm selling here is halfway out to the implied move. So so I strategically chose these strikes because what I'm saying is I don't need to move all the way to the implied move to get my profit here. All I need is a move halfway to the implied move to get my profit. And at least I have a reasonable probability of profit to get this profit. Whereas without the strangle, I don't have very good probability at all of getting my profit. Okay. The statistical probability of profit is not in my favor in this long straddle, but it is substantially, for multiple reasons mentioned, theta improvement, Vega improvement, and probability of price moving to my zone well enhanced. This is a much better trade, in my opinion, than a long straddle. In fact, a long straddle is something that I just never do at all in a through the earnings strategy. Pre-earning strategies, again, you can refer to Option Slam webinar archives, and there are multiple ways to trade a long straddle, but close it before the earnings event. Okay. Now, back to the volatility crush clarification. Let's go to what I said last week was that where is IV going to crush to? And I said, well, it's going to crush to 0. Well, that's true. It's right now, IV for these options that expire on November 3rd is 93. By the end of the day, Friday, there will be no IV left. there will be no implied volatility left for the options that expire on November 3rd, because on November 3rd, those options die. They pass away. They go to that place for options in the sky. And there is no implied volatility on options that are out of the money, because they expire worthless. And there is no implied volatility on options that expire in the money, because they expire with only their intrinsic value. How much money they're in the money by. They have no more time premium. They have no more implied volatility premium. Theta doesn't matter anymore. Vega doesn't matter anymore. At the end of the day, Friday, the only thing that matters is if your option is in the money or out of the money. But what I omitted to talk about, and what I planned to talk about the other day, last week, a week ago today, was how much IV crush should I expect immediately upon the earnings announcement and when the market opens the day after the earnings. So here in this particular case, the earnings are tomorrow after the, no, not tomorrow. Let's see. AMD. Yeah. AMD. Tomorrow after the close. Okay. Tomorrow after the close. So what will the IV crush? Now, what will be the IV be tomorrow? It's going to be even higher than it is today. Likely. I can't guarantee that, but it's very likely to increase between today and tomorrow. Okay. So this will probably be, who knows what. It'll be higher than it is today. That's what I'm going to suggest. The next morning, I'm going to propose to you that IV will crush. That 1 day crush will be all the way down into these numbers that are far out in time, these high 40s. I go all the way out in time to the furthest dated options, and I'm going to suggest to you that by the end of the day, November 1st, IV is going to crush from 93, 94. If it's still there, it's probably going to be higher. Probably going to be 95, 96, maybe 100, who knows what. But let's be conservative and call it 94. 94, it's going to crush all the way down to 48. That's an IV crush of 46 points, okay? Well, what good is that information, Marco? Well, you can model that in to your trade to see what your real 1 day risk is by just simply going here to the more parameters button or wheel or gear here and putting in a volatility crush of negative 46 points of IV crush. And when I hit the enter key, you're going to see the blue line won't change, but the purple line will. So here's my real 1 day risk. My real 1 day risk is down to $59 of loss. Even though I got $340 tied up in the trade, if the stock goes sideways, it looks to me like my 1 day risk is I could get out or make some kind of an adjustment. I don't need to accept the full risk of $340 and just hope and pray that the price goes somewhere over the next 3 days. Because what's going to happen as time goes forward and price doesn't move, that loss is going to get worse and worse and worse until it finally becomes the blue line on the end of the day Friday. So there was the AMD, and let's go to Apple. All right, so Apple's really important. I need to check on let's check on my thing here, my GoToWebinar platform, and see if you guys are still here. Yeah, I think I just did that, Sirhan. Didn't I just do that? Could you translate that IV crush to dollar value? Okay, I think I just did that, right? Does that answer your question? Yes. Okay. Okay, perfect. Great. So I answered your question without even knowing what the question was. So very good. Let's go back to our, here we are. All right, Apple. Okay, Apple's very important. This market is crazy. This market is dangerous. We got all these bad things happening in the world, and we've got the market's been under pressure here for week after week after week lately. And we got a lot of important things happening this week. And uh, we have a chance that maybe we found a bottom or a temporary bottom, if we could get some good news, and Apple could be part of that good news. So uh, uh, I am hopeful, Sam, that you're right, that your bullish attitude towards Apple is spot on. I hope, I pray, I'd like to see that happen. But as Sam mentioned, the what seems to happen with even good news, good earnings news lately, is stocks can't hold that upward momentum. They don't. Now Netflix was kind of the exception. Netflix was under huge pressure, selling, 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 and then earnings came out and they blew earnings out and they gapped up super high, and it was just like, you know, uh, like I say, it was the exception to the rule. But most stocks, I would agree with Sam, just can't seem to hold that upward pressure. But you know what? Good news from Apple will be good for the market. And then if Jerome is, it's pretty sure that we're it, all the indicators are suggesting that there will not be an interest rate increase this event, but very likely, who knows what the language will be. Uh, my guess is they're going to stick with the higher for longer theme, and how the market reacts to that. That's mixed news. That's going to be mixed news. That's going to be okay. No rate increase, but our outlook is higher for longer, and maybe a rate increase coming in the near future, maybe even as soon as the next meeting. Okay, so there's a lot of important things, but I agree. Apple is one of those important things happening this week. There are many, many, many others, but Apple earnings, wouldn't it be wonderful? I'm going to stick with I don't know what strategy you had in mind, Sam, but trying to be bullish on Apple. I need to go back to my risk reversal here. I need to go back. Let me think of, okay, I got an idea. How about this? How about we try okay, I got an idea. Here's another idea for a bullish trade on Apple. And Sam, if you've got something in mind, please put it in the chat. All right, so let's see. I got an idea for an Apple bullish trade on Apple. All right, the implied move. All right, we don't have time to go through all of the option slam um, in detail like we did with the other stocks, but let's do a quick look. Okay, we got an EVR of 1.7, so it's not a huge mover on earnings. So we can't go for the shoot to the moon type of an event just because EVR doesn't justify that. Okay, um, here you can see the moves, the close and max 1 day moves. The biggest move I see on this sheet is 7%. Okay. What's the implied move this week? It's only 5%. Okay. The implied move is 5%. How does that implied move compare to previous implied moves? 5, 4, 4, 5, 3, 5, 5, 3, 4. It's at the high end. So at the high end, to me, I need to correct this. We don't know what the, to be legitimate, well, we don't know, so that's none there, but we haven't moved anywhere yet. Anyway, I'm just talking to myself. Sorry about that. All right, so I'm not super bullish on Apple for all the reasons that we've already talked about. Let's take a look. The implied move is about 5%. 5% of 170 is about $7. Okay, so let's just go out about half the implied move. Let's go. Let's go half the implied move. Let's be conservative, and let's do a butterfly. So instead of going out to $7, I'm going to go out $3.50. Well, where does that take me from 169? That would take me to the 172.50. So I could go to the 172.50 and I could put on a butterfly. Now, the problem with butterflies, especially as they're modeled up in by default in Thinkorswim, is that they are too narrow of a range. Let's look at my one standard deviation out to, I got to change my, let me change my parameters, reset parameters and date. Okay, so you can see there's the butterfly. Here's the pros and cons of the butterfly. It's a very cheap bet. 30 cents, okay, or $30 in other words. $30 with the potential to make as much as over 200. Okay? Everybody see that? So that's the good news. What's the bad news? Well, the bad news is that the likelihood, the probability of profit is not huge, okay? So here's the break evens come expiration day, and the probability of profit is about 25%. Actually, it's not bad. 25% probability of profit, 75% probability that you're going to lose $30. I wouldn't mind going even to the blackjack table, or the roulette table with odds and risk reward, if the risk reward was there. So what we want to do is we want to weigh the probability of profit against the risk to reward. So here the risk is $30 and the reward is potentially up to 200 some. Okay, if we get it right. Now, what can we do with this butterfly to increase the probability of profit? Well, what we'll have to do is take on some additional risk. So what we could do, let me change this to a different butterfly. I'm going to change this to the 170. I'm going to go 175. And then I'm going to go, instead of 180, I'm going to go to the 185 just to illustrate something. Okay. That didn't quite do it. I'm going to have to go up to the 170. There we go. So there is so I don't like the risk here. It's pretty heavy risk here, $700. But here's the point. By changing this to a broken wing butterfly, and I just talked about all the reasons, including what Sam said, is like, even if stocks have good earnings, they don't go to the moon except Netflix. But everybody else has not been able to do anything like that. And for all the other reasons we've already talked about, not to reiterate them all, we don't expect the stock to go to the moon. And the implied move was $7 from stock trading at, where's the live price slice? I got to get one live in here. Where's the live? Let me just see where the live is. The live is at 170. We'll just call it 170. Okay. So 170. There we go. 169.58. There's the live price right there, 169.58. Okay, so here's a bullish broken wing butterfly that does a couple things for me. It puts my risk where I don't think stock can go. I don't think stock can go way beyond the implied move, which is at 177. That's the full implied move, right? 170 plus a $7 implied move is 177. So my risk is going outside the implied move, and my max risk is way outside the implied move. Okay. Given the market conditions, given everything else that's going on in the market, given all the other fears and dangers and overall general market conditions and market sentiments and all the problems in the world, could I be wrong? Yeah, stock could go to the moon. It's possible. I don't know. Can't predict the future. But all the evidence is that this looks pretty safe. And if I'm wrong about direction, and stock goes down, there is no risk to the downside here. I still keep my $27 credit. So there's a broken wing butterfly done one way. Let me do one another way that, okay, let me do one another way. Another bullish broken wing butterfly, okay? So here what I'm going to do is I'm going to go, instead of doing the, let's see, 172, let's do, okay, I'll do it this way. All right, let's see, 177. I will take this down to the 177.50. And now I'm going to move this lower call down to the, I don't need to go that far. 67.50, or even maybe the 170, maybe even the 170. I could even come up. No. I'm sorry. This is fine. This illustrates the point I wanted to illustrate. Here's the other way to do a broken wing butterfly. So price is trading right now at 169.69 right here. So this is a bullish broken wing. But the difference between this broken wing and the last one I showed you is this one requires me to be right about direction. I have to be right about direction, or I'm going to take this loss of $1.59. If price goes anywhere in the wrong direction and I hold it till the end of the week, I'm going to have this full loss of $1.59. If price goes up halfway, like I suggested it could do if it's bullish reaction to earnings in any way, then perfect. It goes right to my maximum profit, half of the implied move, or just over half of the implied move, takes me to my maximum profit, risking $163 to make $330. So the risk to reward is good here. Very good, right? Risking $159, it's $160 to make possibly as much as $300 or more. And even an overshoot, though I discuss how I believe that's unlikely, but even well, think about it though. Who knows what Jerome's going to say? Maybe he says something that is bullish for the market. And if Apple has good news and Jerome has good news, and there's other good news in the geopolitical situations, who knows? Maybe, who knows? But it's possible that there's an overshoot. Anything's always possible. All right, I think there was one more stock, but we are way over time now, and I'm going to have to call it. So, yeah, you can design these strategies to be bearish as well. Do the broken wing butterfly on the bearish side as well. Okay, very good, folks. Thanks for being here. I am planning to do another webinar next week. Let's do it again. If you've got some stocks you want to bring to the table, send me an email, and we'll review them in the next webinar. In the meantime, I'll say goodbye for now and wishing you all good trading.